Hey, income harvesters and growers, welcome back to the channel. Today, we're going to talk about an interesting discussion or topic that I had with someone when I was talking about covered call funds that pay weekly distributions. Yeah, this discussion was pretty interesting with a couple of people, and some of them were asking about how covered call funds are able to pay weekly distributions. Is it really possible, or is it true, and so on? And the short answer is here, like it's on the slide, you can see the zero DTE covered call strategy. That's the strategy which enables these funds to produce um, regular income on a daily basis, and they're able to make weekly distributions. So, short answer is it is true, it is possible. And how it works, what are the pros and cons, and how the strategy works, and what they're able to do to generate that income. It's all interesting stuff. That's what we are going to talk about in this, discussion or in this presentation. So before we go ahead, this is only for knowledge purposes and for sharing my experience and also educational content, not for financial advice. So with that said, let's quickly look at the overview of the discussion. We are going to talk about the covered call funds which offer weekly distributions and whether it is true or hype, is it sustainable? That's the first area that we are going to, look at and try to answer or address the question. The second would be like, what's the investing model that these funds use that generate income? So, what's the secret formula, secret sauce they are using? So we look at that and how they are able to provide those high frequency distributions. And yeah, continue with the second one. We also look at specialized zero DTE funds. So, what is zero DTE funds? I will explain to you when we get there. And these are the funds which are able to generate this high frequency of income, and that enables them to offer high yields plus higher frequency of income weekly distributions. And like any investment strategy, any fund type, for example, this one also has its own pros and cons. So what's the deal here? What are you getting here for your investment, and what's the catch? What are the limitations? What are the drawbacks? you know what are the things that you need to keep in mind, like, because you cannot just go all in on one fund or one type of strategy. So that's something which we will discuss. And if you're watching this video, this is something which you need to know, because you need to know the pros and cons, both sides of the equation, so you get a balanced opinion of the fund and how it works. And continuing with the same point, like, what is this for and who is this for? Is that going to be a get rich quick scheme or a get rich soon idea, or is it going to be a cash flow booster? Is it going to produce a large amount of income, and how do you use that, and how does it help in your portfolio? So all that we are going to discuss as we move to the end, and how it fits into your overall portfolio, which will serve like a conclusion. Or here I'm going to add some of my thoughts also, and some of my observations, just to add some value based on what I experienced. So I hope this will be a great topic to discuss, and I look forward to covering similar topics, and look forward to your questions, feedback, and comments. Okay, first let's address the bigger elephant in the room, like, which is the covered call funds weekly distributions. Is it true or is it a hype? Is it really sustainable? Okay, let me give you different aspects of this. Like, I'm not going to give you the exact answer, but let me break this down. Uh, it is true, it is a hype, and then I'll add some extra points to support what I'm saying. The true part of it is like these funds are able to potentially earn premiums every day, like potentially earn premiums every day. So which means that the earning part, they could make a profit, they could make a loss too. So imagine, like, if you are familiar with your day trading or any other types of trading, swing trading, you sometimes make profits, sometimes you make losses. Sometimes your stop loss get triggered, or sometimes the market turns against you. Sometimes your strategy doesn't work. Whatever happens, there is a success rate. Like, you cannot be 100% successful. Same thing applies here. The success rate and magnitude of success will influence the income, and that will influence your distribution. So that if the fund makes X amount of income, and based on that, they will decide how much they want to distribute. They want to distribute the entire 100%, or they want to distribute 90% of the income, and keep 10% for any buffer. It's all internally decided by the fund. One fund may differ from the other. It's all variable. Second part of it is the hype. A lot of funds go to high yield. Like if you go to the websites, you'll find like 60% yield, 100% yield, and so on. In some cases, the high yield is actually true. In some cases, it is just not true because it is based on the latest distribution. So in the recent month, the fund might have declared a high dividend. So if you multiple, or in the recent week, the fund declared a high dividend, let's say, which equates to something like half a percent. And when you multiply that half a percent, the weekly payment, and multiply it by 4, it becomes 2% a month, which is like 24% a year. And that looks pretty high. And some funds do like 4 5% a week also. Like it goes crazy. But every week, every period, the dividend distributions are not going to be consistent, or it's not going to be stable. It's not guaranteed, and it could vary dramatically. Like in one month you might get a huge payout, in the other month you get very low, and sometimes you get moderate. Sometimes it's gets stuck in the low range for a long period of time. So it's not steady or constant. Like in case of like blue chip stocks or some dividend ETFs, you may get a steady stream of income. For these funds, that's not true. It is going to be highly variable. Sustainability. So this is actually debatable. It differs from fund to fund strategy. And even if the fund is the world's best fund with the best team and all that, the fund is actually investing in the index. And so it also reflects the performance of the index. And also the ability of the fund to capture the profits weekly will determine the success. And if they are able to make profits every week, they may make some losses on certain days. So net, they should be able to make profits. Some days they make premiums, profits. Sometimes they lose a little bit of money. So winning days minus the losing days, the amount of money gained and amount of money lost. So if you net it out, you're going to get the net profit or loss. That should be sustainable. And if that is sustainable, they're able to produce, sorry, they're able to distribute those gains to investors like you and me in the form of dividends. Imagine a systematic way of investing in index funds every day. If you're able to invest in index fund every day to capture the gains, which means you're also capturing the losses. Like you cannot just capture only the gains and not capture the losses, because you have a systematic way of investing. And these funds follow the systematic or rule based method. And so that's why you have this um, winning and losing both happening together. Like based on the probability or based on the historical data, it says that the markets tend to go up over a period of time. Over the long term, they generally tend to go up, and in the short term, there could be a lot of fluctuations. And based on the data, the returns of the market over a longer period of time, 50 years and so on, based on research, empirical data and research, it was found that the returns are somewhere around 10 to 11%. On a conservative basis, you can say 10% per annum. That's the return of the overall index of the market. So the price movements keep the you know um, gains minimal, like, because the fund is able to monetize those price movements, little bit of price movements every day. Like they're not going to hold it for a month or a longer period of time. They're able to sell some options in the morning and then close it off in the end of the day. So that way they're able to capture those gains. Now, I know this is a little bit technical. We will come to that part later, how these funds earn these daily premiums and the technical aspects of it. We will touch upon that in the next few slides. I'm going to give you an example to give you an idea, but this is just a crude or rough example. Imagine a mango farm or a mango orchard. Like, so this is completely out of the box example. Like, then if you understand this, then you will understand how these covered call funds work, zero DTE covered call funds. So the traditional mango orchard is like a traditional covered call. Like they do this kind of uh, harvesting where they harvest the raw mango or the mango fruits. So early summer they are able to do more raw mango sales, and in summer they are able to sell all the fruits. And by fall everything is done. They do a little bit of end of season sale or disposals, or they just get rid of the stuff and dispose it off and so on. So it's basically a seasonal business. But however, some of smart mango farms, they have found ways to actually extend the life cycle of the business, or they extend the revenue cycle of the business into other seasons or other times of the year. So how are they able to do that? Like, let's look at it. So in spring, they're able to do the tender mango pickling or sapling sales. Okay, tender mango is a very small mango. If you're in the southern part of Asia, you know these things. You might have seen tender mangoes. Tender mangoes are used for pickling, or sometimes they're used in the dishes or salads and so on. And they're also saplings. Mango saplings are used to just to sell it to people who want to grow their own mango trees or in their garden or in their backyard and so on. That's the spring season. So even in the spring season, they're able to, do some business. And in the early summer, they do the raw mango and the early fruits are being sold. Summer, obviously, they sell the fruits. So up to this point, it's a mix of spring and summer sales they are doing. And by autumn, they should be done actually. They're done for the whole year. But what happens is the fruit, there is some bit of fruit they can still sell. And there are mango leaves which are very popular and highly in demand because of the festival season which starts in the autumn season. And in these festival seasons, there's a high demand for mango leaves. And by the time it's winter, there's a demand for leaves, there's a demand for byproducts, and also there is a greenhouse setups. Like for example, there are some farms, the modern, state of the art farms where they have the greenhouse effect. They can simulate the summer like conditions within a greenhouse or a glass kind of farm where they can replicate the summer weather, including the sunlight, the environment, the temperature controls, plus also the moisture controls, plus various other things. They can also fertilize a little bit. So basically they're trying to make a summer like effect within a greenhouse setup so that even in the winter or regardless of the season they can grow mangoes. How beautiful is that? Like, so even in the opposite season, like they're able to harvest mangoes. Those are the sophisticated state of the art farms, modern ones, but not the regular smart ones. So look at the amount of smartness that these farms are getting into, like high tech, uh, you know, technology that they are using. And some of them are able to do all seasons because of the above factors. They're able to do mango leaves, sauces, pickles, byproducts, so many things. Some of them even sell mango jelly and all that. So that's the beauty of it, because when they are able to do all seasons, these byproducts, they're able to extend the revenue cycle. And when you're able to extend the revenue cycle, you can not only sell in that city, the mango fruit can only be sold in that city or maybe sent to the other nearby towns, a little bit of exports. But if you do these more of these byproducts, you're able to sell it to neighboring cities, neighboring states. You are able to transport from east to west, north to south, and you're also able to export outside the country and send it to different nations, earn foreign exchange. Plus, you're also able to, sell it in the grocery stores and into the retail chains and so on. So your entire business model and revenue cycle has been extended and diversified rather than depending on one particular season. But you're still focused on your core business, which is the mango. So if you understand this, the same concept will apply to what I am going to discuss. Although these are completely different, it's a crude example, not exact. But you'll understand once I go further. Okay, so what are we talking about? Let's talk about the investment part of it. Like, what is the investing model that generates such high frequency distributions? That's the $1 million question, right? So there are two parts of the strategy. The first two I have put it in the first 2 points, and the third one you can see, which is also part of the same. The three major areas. The fund buys long, deep in the money options. Deep in the money option would mean like call options which are profitable. Like let's say the Apple's current market price is $220. You buy the $200 call option, which means that it is already making profit in the money, and you are buying a long means like the expiry date is like 1 year further apart. Like, let's say we are in August 2025, you will buy options which are expiring August 2026, 1 year from here. So why the fund is doing that? So it's actually cheaper for the fund to buy the in the money options rather than buying the Apple stock. Just to put it in another way, um, you are familiar with index and futures and all that. You can buy a particular stock or you can buy the stock futures. Similarly, the fund is actually buying long in the money option instead of buying the stock itself. Because if they buy the stock, they have to buy in multiples of 100. But if they buy the in the money option, they buy they're still buying in the multiples of 100, but they are actually paying less premium. They're not paying the full price. They're paying probably 50% less, but they are able to control the same amount of shares, same amount of portfolio. That's point number one. Point number two is there are zero DTE options. Zero DTE stands for zero day to expiry. Zero day to expiry, meaning the option contracts expire within the date they are traded. Like basically, today, if I am trading the option contract, by end of today, when the market closes, the option contract is expired. So it just lasts for one trading session. So these are the options the fund will look at and they will write or sell these options. So that's the third point. The fund actually identifies these options and they sell or trade these options. Trade means they will sell it at some point and buy it back at some point. So they sell high and buy back lower, probably at the later part of the day. And that's creates a potential for profit or loss. So when they sell high and buy low, it's up, obviously profit. But sometimes the market goes up after they start selling it. So in that case, they may be sitting on losses. So every day you're doing this trade. So when you're doing this trade every day, like it's like in a week you're doing 5 strikes. So every strike is not going to be profitable. So out of five, 3 times they may make profit, 2 times they may lose money, or it could change depending on the market conditions. Ideally, the amount of profits should be exceeding the amount of losses. So net net, the fund makes a profit. So that's how the model works. So if you understand this, like um, you understand that the fund is generating premium every day, technically. So this is how I'll explain the traditional covered call and also same for the synthetic or the zero DT covered call. So you will understand both. In the traditional covered call, you have the income from the profit earned from the option premium. Option premium is sold and options are bought back. And you have capital appreciation, which is the increase in the stock price, obvious. And you also make capital gain or loss uh, when the option when the option gets assigned. For example, uh, the underlying stock goes up and the underlying stock goes beyond the strike price. So what happens is at the strike price, the appreciation is capped. So when the stock price hits the strike price and goes above, the option gets assigned and the fund has to make the capital gain or loss. So that's the capital gain or loss which happens due to the option assignment. And you have the dividends from stock. So these are different sources of income for the traditional covered call. And traditional covered call is pretty good because it has these different sources of income and it's pretty more diversified and more safer. And the frequency of income is monthly, and the fund distributes the income monthly. Usually, that's how it works. But there are some funds who also write weekly options and so on. That's a bigger topic that we can look into. But this is how the traditional covered calls work. Now, let's look at the zero DT covered calls. The structure is the same, but just the type of instrument they are using is a little different. Okay, synthetic covered call using the deep in the money call plus zero DT call, right? Okay, income is basically profit earned on the option premium. They write the options in the morning and then sell it back in the, sorry, buy it back in the afternoon or later part of the day. That's the income, premium income. And capital appreciation increase in the long option value. Basically, they write deep in the money call and the value of the call or the option increases. Then they get that capital appreciation. And capital gain or loss can also happen when the option is assigned, and these are technical stuff. The fund is managing it, you are not actually doing it, so you don't need to know exactly these mechanics. But reason for me explaining this is to show you how these funds make income. Frequency of the income is every day, they are able to do it every day. However, the distribution frequency is weekly. The reason it is weekly is because it's not possible to distribute uh, you know income every day. And if they are able to look at it for a week, they know how many trades went good and how many trades went bad, and they know the average success rate and so on. So by the end of the week they know how much to distribute. So that's why it's weekly. And of course some of the funds could do monthly also, like there are funds which use the same strategy but distribute monthly. So again, there are so many permutations and combinations here, but we are looking at typical zero DT funds which have weekly distributions. That's our topic today. And the only difference I see here is that these funds cannot get dividend from the companies or the stocks they hold, because they are not holding the stock, they are holding the options, long dated options. That's the technical difference. Other than that, most of the above points are similar to a traditional covered call ETF. Okay, now let's move to the next area. Now that we have a good understanding of, you know, difference between a traditional covered call and a synthetic covered call, I'm going to just extend it a little bit. Like some of you are already familiar with my channel, you have watched a lot of my videos, and so some of these topics could be familiar, and some of them could be, little difficult to grasp. So if you have any questions, any comments, anything you want to know more, you can drop in the comments below. If I am able to answer them, I will answer them and try to clarify. Or if it is too technical, I'll try to get the information, or I'll try to do more research and find the, answer to your questions as far as I can. And here I want to quickly point out the probabilistic advantage that daily covered calls, 0DT covered calls have. The traditional monthly covered calls can do 12 trades in a year. Okay. We are talking about 1 year, one calendar year. And strategy adjustment, like if the fund manager wants to adjust a strategy or change it. So once the current call expires, then in the next call, the next trade, they can make the adjustment. Next trade, meaning the next month's trade, they can make that adjustment. Some of the funds are now doing also weekly, calls. So this would have changed. But I'm looking at traditional monthly covered calls. And capital appreciation, this depends on the fund's strategy, whether they write calls at the money or out the money. Out the money covered calls usually capture more capital gain, and they're able to appreciate little faster than the at the money covered calls. At the money covered calls gains are capped, so it takes a lot of time for them to appreciate. If you are invested in all these XYLD, QYLD, global X funds, you might be familiar with this at the money covered calls, and daily covered call. That's the new ones that we are looking at now. How are these so different? Like what kind of magic that they're offering? Let's look at it. They do trades like every day. So technically in a year, barring any holidays or any non-trading days, they are able to trade on every day, and they are able to capture premium every day. Like technically, every trading session they are able to do that. So which means they have more strikes. Imagine that you might have learned in your math or statistics. Like if you toss a coin many times, you are able to get to that probability of getting a head, is 50%. You're able to get to that 50% probability when you increase the number of trials. But when you do only, 10 tosses, probably you may not get, 50%, like probably you may get 70%, heads. So the same concept applies here. Like when you extend the number of trials, there is a kind of standard average or a probability of success in the market. So you achieve that probability. It could be 60%, 70%. We don't know. It's not exactly 50%, because over a period of time, markets go up. So it's not like a head and tail, like 50-50 situation. The markets keep going up. On the upside, the probabilities are unlimited. Like market can go to infinity technically. On the downside, market can go to zero. I'm talking about index or even a stock. So so the probabilities are not exactly like a equal and bell curve shaped. It is a little bit skewed. Uh, Without going into the statistics and technical part of it, here the beauty of this strategy is the strategy adjustment can be done every day. Like so, every day the fund manager can look at it and adjust their strategy. Like if they see that the market is going on a very sharp downturn, they can write calls right away in the morning and then capture the gain, because they can write or sell the call in the morning and then quickly capture the gain. But if they see that the market is trending up pretty fast, like they can give it some time, see where the top, you know, forms for the market. Like at some point in the day, the market is going to hit a peak, and at that time they can write a call and then quickly capture the premium. So these kind of strategies they do it internally, and it's not 100% perfect. Again, success rate can vary from one fund to the other, and that's how they can adjust the strategy. And capital appreciation depends on various factors, like overnight if there is a positive news in all the markets across the world, like the index can appreciate overnight, so that can improve the net asset value of the fund. or if the index moves up continuously for a long period of time, like let for a week or 2 weeks, then obviously you know the value of the fund is going to go up. So the good news is that in terms of the premium capturing and in terms of the success rate, the daily covered call has a higher chance of success, because even if they do a wrong trade, like they can do more trades to reduce the failure rate. And if they do good trades, the correct ones too, they can do more trades and increase the success rate too. So, so these funds have a kind of a, it's a kind of it's like a leverage, you can say. Like it has pros and cons both ways. Like, because if you are going to do more losses, like 3 or 4 days in a row, obviously it's going to erode the value of the fund. Okay, so that way it is a con. But if the fund is able to make profits 3 or 4 days in a row, it's going to the value of the fund is going to go up tremendously. Like, but in the first one, the monthly covered call, like you make a very good um, premium income in a particular month. But next month, it's a completely different story. Like, and by the time you go to the next month, the entire market, the cycle, the environment completely changes. Like, and you only have 12 opportunities in a year to make trades. But in this case, you have 200 plus opportunities to make trades. That itself gives you an upper hand in terms of probability of success. So the trader or the fund manager has more strikes to correct their game, improve their game, or enhance their income earning strategies. So that's what differentiates these funds from the traditional covered calls. Okay, now the personally, like if I had to do my own covered call writing, like if I own a stock and write covered calls on that, in that case, I would only be able, as an individual, like with a limited funds and limited technology, limited resources, I would be able to do a traditional covered call, and the margins and capital required for that is pretty high. I would not be able to do this zero DT call writing, because it's a very sophisticated strategy. Like, you need to buy in the money calls which are long dated. That's a big investment. Plus, you also need to write calls every day to capture that everyday income. So it's going to be impossible or practically very difficult for individual investors to replicate this zero DTE strategy. Some people do that, but it's going to be difficult for me personally. If some of you are familiar with this or you have worked on this yourself, please feel free to share your comments and thoughts on this. And I like to hear from your point of view how things work. Okay, with that said, let's go to the next area. Some of these funds, specialized zero DTE funds. Okay, if you're watching, new, this is zero DTE refers to 0 days to expiry. And some of these funds I have discussed in the previous videos. You might be familiar. If not, just feel free to go back to my previous videos and look at the fund face off or the videos section where you can find videos on these. XDTE, Roundhill S&P 500 0 DTE ETF. This is from Roundhill, and SDDY, which is a relatively new fund launched somewhere early part of this year. YieldMax S&P 500 0 DTE ETF, and WDTE, which is a pretty older fund, like which is older than the XDTE, like defines S&P 500 enhanced options and 0 DTE ETF. All these three funds have a similar strategy. They could be minor tweaks or changes, but they have a similar strategy. Like the one I explained, the common features are all funds use a mix of long in the money call plus 0 DTE call writing, and all of them follow the respective index. And now I'm giving the example of S&P 500. Now you have similar funds for the Nasdaq, Russell 2000, and more funds are coming up in this space. So there are a lot of new products are also coming, which are there are some products where they write weekly calls on specific stocks. For example, Nvidia weekly, you know, weekly income fund, and so on. Like even Microsoft, Amazon, and so on. But those are different. They are not zero DT based. They are based on other types of strategies. So just keep in mind that any fund which is paying weekly doesn't mean that they are investing in they are doing the zero DT strategy. This is mostly restricted to index funds as of now, and there are specific funds which follow this strategy. So it's important for you to go to the fund's website, go to the prospectus and read their principal investment strategies or key investment strategies section to understand what they are doing, how they are investing, what exactly is being uh, invested into, like where is the money going, basically. That's the question you need to ask. So for example, in these cases, the money is technically being invested in the S&P 500. No matter whether you call it traditional covered call, zero DTE, this, that, you can look at any type of fund. If the fund is doing a covered call on S&P 500, the fund is investing in the S&P 500 and writing covered calls. Like, so at the end of the day, you should have a strong belief or conviction in the main index or the underlying asset. So if you know the underlying asset and you're convinced with that, then writing covered calls using that strategy helps. But if you're not convinced with that stock or the index, for example, you're investing in Tesla, covered call fund. If you don't know about Tesla or their business, or you don't understand that, then there's no point, choosing that fund. You have to be clear about what you invest in. That fundamental concept doesn't change. That boring investment concept doesn't change. You still need to invest in blue chip stocks, or choose broad indexes to invest in. Okay, so these are the funds which I have looked at. There's no ranking or any specific thing. I'm just giving you examples, and this is not financial advice. Okay, next, moving into what's the deal, what's the catch. Okay, this is the interesting one which we discussed earlier. Like, there are only two goals you're trying to achieve with these funds. You're able to replicate the covered call underlying using the in the money long position proxy for the index or stock. So you're buying the in the money call instead of the stock to replicate the same kind of formula, and you write every day the zero DT call options to generate the premium income. That's the simple two goals that you're trying to achieve. When I'm saying goals, these are the goals of the fund, and these are the goals for the investor too. So because the fund is working for the investor, and as I said earlier, it's the same point. Exposure to index is similar to investing in an index ETF. The fund goes up or down with the index moves. So there are some people who say that, oh, the index went down, but my fund also went down. So what's great about this covered call? It's doing nothing. It does nothing, basically. Basically, what the covered call does is it generates that little bit of extra income even when the market falls. So market falls by 10%. The covered call fund may fall by 8.5 or 9%. The reason is that extra premium is giving you the little bit of profit to offset your losses. So the better way to explain that is, in one of my previous videos, you can look at it. I explained that this covered call fund, whenever the market is down, functions like a shock absorber. Like, if you are driving high speed, what do you call that? High performance bikes or motorbikes, or even the sports vehicles, these vehicles are able to withstand all those potholes or rough conditions, because they have these shock absorbers which are able to take those shocks. Imagine driving normal scooter versus driving a Harley Davidson. There's a huge amount of difference. Like, the quality of the ride and the shock absorbers, the comfort is completely different because they have those shock absorbers. Think of these covered call funds like a shock absorbers which help you deal with those market shocks. You're not going to be completely protected from all the losses or anything. The risk always exists, but since you're cushioned from that, you are able to gradually focus on your investment game plan and stick to your long term plan, rather than trying to sell or panic or do this, that. You don't have to worry about that. If you're invested in the index, and the fund is actually doing covered calls on the index, you can stick on to the index because index is not going to go to zero. So you stick on to your investment plan and you still get that income when the markets are down. And over a period of time, you're going to collect a lot of premiums, which is going to be enormous amount of yield. And that can be reinvested back in the index, or you can invest in other funds, other stocks. The options are plenty. Like, so that's the beauty of these funds, that they are able to give you that extra cash flow or money in your pocket to give you additional options, rather than trying to you know put every month you're trying to save some money and invest. Nothing is coming back to you. In this case, some money coming back to you, you're able to invest back without putting a large amount of money out of your pocket every time. So that's the beauty of these funds. It creates that cash flow option. What is this for? Get rich soon or cash flow? The answer is more like a cash flow booster. It is not a get rich soon option because let me be very point blank here. Because the capital appreciation is capped in covered calls, and some of you are familiar with these funds. Most of your the people who are watching regularly, you know that the capital appreciation is capped. So where is the question of getting rich with that? So yes, a decent cash flow booster. And remember the fact that when I say cash flow, there is also a catch there. If you're someone looking for regular income for your expenses or for your needs, like you're a retiree or you need that income for your expenses or you're planned that way, sorry, it may not work like that. Let me repeat that. If you are going to be dependent on this cash flow for managing your income or lifestyle or whatever it is, the cash flows are highly variable. It's That's something you need to keep in mind. Are you able to live with that variability or not? If you're able to live with that variability, yes, probably it's a great option. It works for you. There are some people who say that I am traveling, I am moving here and there all the time, and my funds are generating, $10,000 a month, $8,000 a month, and so on, because they have invested probably a million. So that's how it works for them. So does it work for you? That's the question that you need to ask yourself. So don't get carried away by all these, gurus or YouTubers who are promising or giving you the impression that you will be, making thousands of dollars sitting on the beach and doing nothing. That's too good to be true. So cash flows are highly variable, and the other bigger catch is there will be some capital erosion. Like when there is a frequent distribution of capital back to shareholders or unit holders, there's a little bit of value which you are taking out from the fund, which means the net asset value is going to go down. It's simple as that. You have a mango tree producing 100 mangoes. You already harvested and you already taken out like 10 mangoes. So out of 100 you have taken 10, so you have only 90 on the tree. So so only that 90 probably can be, some of that can be sold later, or you can convert that into seeds or sauces or whatever. So in this case, what happens is you cannot get both. Like you cannot have the cake and eat it too. Like you can't once you have taken out the money and you have put it in your pocket, like you have put it in a different bucket, it's come out like from the fund, so it is going to erode that value. So that's something you need to keep in mind. And because the fund is taking out the money to pay to unit holders every week, there is going to be a little bit of that erosion. And whether you want to be just stick on with your investment without reinvesting, or you want to wait for the fund to fall, erode, and then you want to invest more when the value is down to get a better yield. Those are all the different questions and options that you can explore. So right now I'm not going to tell you what to do. It all depends on your situation, depends on the fund, the market conditions, various factors, but the options are always open for you. So the short answer for this is it gives you that cash flow boost, regardless of whether you are a growth investor, value investor, income investor, hybrid, whatever style you follow. You want to have one of these in your portfolio to generate that regular income. Like a lot of people in today's time, like there were times when people were able to generate a lot of savings from their income. Like they were able to save thousands of dollars every month, and investing 500 a month or 1000 a month was pretty easy. Today's times are difficult. Like you have higher inflation, you have lack of savings, and unpredictable markets, unpredictable job markets, unpredictable situations, technology change, regulatory change, and people don't work for the same organization for more than a couple of years now. And after a couple of years, either they resign and move on to something, or they get laid off, or things happen, or there's an artificial intelligence, or some new technology, some new thing coming in and completely, disrupting the industries, disrupting the way business is being done. So in these times, you need some kind of a cash flow boost. Oh, some people say that, oh, I have enough money. I want to, keep it like that. I don't want your dividends. I will grow it and I will compound it over a period of time. Sorry, this theory worked decades ago. No more. You cannot trust these concepts anymore. The textbook compounding growth concepts, which I also applied myself, and I myself have worked on all these, value growth strategies, found that it works to some extent. But once you lose the money, once it doesn't work, then there's no way you are going to just justify it, because the problem is once you lose money, the you're out of the game. Rule number one is like you should not lose money. That's what Warren Buffett says. And rule number two is follow rule number one. And one of the ways you can ensure that is to have some kind of a venue or a product that can give you that regular cash flow, because you cannot trust the companies, you cannot trust these the company heads to take the right decisions. Tomorrow they may make a wrong acquisition. Tomorrow they could do something like uh, take a high amount of debt, or the profitability may go down. Anything can happen. If anything can happen to your career, your job, your mortgage, your day-to-day life, anything can happen to your investments. Why should you trust anyone? So do your own research and try to find funds that are able to, complement your portfolio and add them, gradually. So these funds are used for regular income or uh, distribution or cash flow. How do you use that cash flow? That's the second part I'm going to address. I already explained why you need the cash flow. I don't want to go into that again. So if you're reinvesting back into the same fund and you want to grow the cash flow, that's one option. That's not the ideal one. So imagine you have other investments. So you decide that I want to grow this investment and increase my cash flow. So I'll reinvest back into the same fund because I have other investments taken care. So I will do that. That's one option. Or invest in other stocks or ETF. I have a small portfolio. I just have one covered call fund. Now I want to invest in a new stock. Like some stocks are very cheap now. Like I want to buy that. Utility stocks are cheap. So why not, look at that stock and buy that and diversify my portfolio? Or let me buy some a different kind of ETF. Instead of buying the covered call, I will buy the regular index ETF, or I'll buy a sectoral technology fund or something. So you can look at different options. Or you are someone who want to look into other asset classes. I want to invest in gold or cryptocurrency. So you will look at other assets, not just the stock markets and bond market. You're not stuck to the textbook, theory. Like you want to go beyond that because you want to diversify across asset classes. So that's another option that you can explore. Third one is like another practical point that I wanted to add here. Many fund managers, advisors, and etc. They also may not stress on this, but this is one of the factors that you need to look into because sometimes you're not able to do certain strategies or certain investment because like you don't have funds for the managing the fees or a margin or so many factors. And similarly, when it comes to tax season or tax time, and your accountant gives you some suggestions, but you don't have time to do that now it's already end of the year or it's already gone. Like so plan ahead of time and you can keep some money for margins, for any additional brokerage or fees, taxes, etc. So that way you have that extra buffer for these things. And sometimes if you want to do, like let's say you want to do your own options trading, or you want to buy more of blue chip stocks using margin. So if you want to do a little bit more, you need that extra leverage or extra margins. So for that, you need extra cash. So this cash flow can be used for that too. And similarly, you can save or conserve cash for withdrawals, personal needs. Tomorrow you want to sell and take out some money, cash out some money, or probably you have to pay some other expense, credit cards or mortgage or something. You want to cash out. So that's another option that you can look at if you think that, currently I'm doing well, but I want to take out some money for paying my debts off. That's another option. So I hope you like this video. Now we come to the end of it. And so my closing thought is like these funds are an excellent option for regardless of whichever investing style you're using. You can add it as a small part of the portfolio. And for the income investors, this is going to be a good option, like obviously, because you are looking for income. And instead of looking at single stock covered call ETFs, you can look at index covered call ETFs. Not necessarily S&P, you can look at Nasdaq or even Russell ETFs. So that way you are able to capture these regular income, and also you have the safety because you are investing in the index, not the individual companies. So you are investing in the basket. So that way you're automatically diversified, just like investing in the index ETFs. I hope you like this video and the presentation. If you have any questions, comments, feedback, feel free to share in the comment section below. I would be happy to answer that. Thank you. Happy investing.